The retail investing crowd has spent the last 2 years bracing for a catastrophic real estate debt cliff, but the primary filings show that the exact opposite is happening for conservative balance sheets. Sector borrowing benchmarks have quietly created to cycle lows, turning a widely feared threat into an earnings tailwind for the right operators. If you are holding Singapore real estate investment trusts for retirement income, here is exactly how the refinancing wall just became a myth. For 24 months, analysts warned that Singapore REITs would see their distributions decimated when cheap pandemic-era loans matured and had to be rolled over at higher rates. The market consensus was clear. It was also completely wrong. The ground has shifted beneath us in 2026, and the primary filings tell a story that the crowd has not yet priced in. Headlines skip the math. I do not. I pull interest coverage, gearing, and free cash flow sustainability into plain view, so the local investor compounding dividends or drawing them for living expenses works with institutional-grade clarity. Momentum strategies tolerate more risk and can clear a higher bar. A retirement portfolio built for capital preservation and reliable income needs a forensic filter, and that filter is the point. Data from third-party sector coverage, including DBS Vickers and UOB, confirms it directly. Loans maturing across the 2026 to 2027 window are carrying legacy borrowing costs up to 200 basis points, 2 full percentage points above what the same debt would cost to refinance today. The commercial property sector is entering what institutional analysts call an earnings upgrade cycle, a period where corporate profits are adjusted upward due to falling structural costs. This is a rare structural gift for conservative balance sheets. 200 basis points of legacy premium on maturing debt is not a rounding error. That is the difference between a distribution that holds and one that gets cut. For the Singaporean managing a retirement income portfolio, that gap is the difference between a predictable quarterly payout and the surprise announcement from the manager. The upgrade cycle is real, but it only benefits operators who manage their debt schedules conservatively enough to step into it cleanly. The primary driver behind this shift is the collapse of the 3-month Singapore overnight rate average, or 3-month SORA, the volume-weighted average rate of borrowing transactions in the domestic interbank market. The 3-month SORA has fallen from 3.07% at the end of 2024 to roughly 1.0 to 1.1% as of mid-June 2026, sitting near cycle lows with no clear renewed hiking signal. Fresh debt is now severely cheaper than the loans it is replacing. The market treats the interest rate environment like a single blanket suffocating the entire sector. It completely misses the timing mismatches hidden inside individual debt schedules. A REIT that locked in expensive fixed debt 3 years ago is now stepping off a high-cost treadmill directly into a low SORA environment. This is not a debt cliff. It is an operational cost-cutting event that prints cash directly into the distribution pool. The crowd is still trading yesteryear's panic, while the smart money is tracking today's filings. The refinancing wall has dissolved into an earnings runway. To see who stands to capture this structural windfall, we have to look directly at the leverage profiles of the major retail operators. Screened from the latest quarterly filing disclosures, we map out gearing as total debt divided by total assets, alongside the interest coverage ratio, which measures how many times operating profit covers interest expenses. 4 names lead the scorecard: Frasers Logistics and Commercial Trust, Keppel DC REIT, Capital and Integrated Commercial Trust, and Capital and Ascenders REIT. Frasers Logistics and Commercial Trust stands out immediately. Its gearing ratio stands at 34.8%, the cleanest balance sheet in our entire macro survey, landing firmly as a Zone 3 conditional asset due to its operational discipline. Its interest coverage ratio sits within a stable 3.3 to 4.5 times range, well clear of the baseline floor. It has zero near-term exposure to legacy rate shock and sits perfectly positioned to deploy capital into cheap floating debt. Keppel DC REIT shows gearing at 35.1% as of the March 31st operational update, down marginally from 35.3%. That improvement came from foreign exchange movements in Japanese yen and euro debt, not direct repayments. While this technically sits just a hair above my conservative 35% ceiling, this is a border case rather than a worry case. Its interest coverage ratio stands at a massive 7.2 times, well clear of my 4 times baseline, and 84.8% of its total debt is fully insulated on fixed interest rates, nullifying immediate refinancing volatility. For Capital and Integrated Commercial Trust, gearing stands at 38.6%. While the raw leverage number appears elevated, context matters. CICT carries a highly resilient debt maturity profile, with 74% of its debt fully hedged on fixed rates. negligible maturities across the remainder of 2026 and 2027, and its interest coverage ratio verified at 3.7 times. It holds roughly 2,300 million Singapore dollars in debt headroom before hitting regulatory limits. The headline gearing number is not the full story here. Capital and Ascendas REIT shows a gearing ratio of 37.3%, paired with an interest coverage ratio of 3.6 times. This stable combination reflects the direct benefit of recent equity fundraising initiatives. The manager issued new units to pay down outstanding credit lines, protecting the underlying asset backing from capital erosion and stabilizing the leverage profile. Strategic dilution in service of balance sheet repair is exactly the kind of management discipline this forensic framework rewards. The macro tailwind will float many boats, but my forensic flaw exists to highlight where structural pressure remains dangerous. Two names in the survey show why generic sector optimism will get you trapped. Fraser Centrepoint Trust shows a gearing ratio of 40.0% alongside an interest coverage ratio of 3.5 times, approaching the caution line. Strong sponsor backing and minimal near-term debt maturities mitigate immediate rollover risk, but the gearing level demands ongoing monitoring. Suntec REIT carries a gearing ratio of 41.6% and an interest coverage ratio of 2.2 times. This is the exact profile where the debt wall narrative remains completely true. It faces a steep maturity concentration with approximately 900 million Singapore dollars due in 2027 and a massive 1,400 million Singapore dollars coming due in 2028. Management must execute flawlessly across that window to avoid cash flow strain. The macro tailwind provides some breathing room. It does not provide a margin for error at this coverage level. The single sharpest finding in the entire scorecard belongs to Lendlease Global Commercial REIT. Its gearing ratio stands at 38.7% or 37.5% on a pro forma basis following recent adjustments. Its interest coverage ratio has deteriorated to 1.8 times, sitting dangerously close to the regulatory minimum floor of 1.5 times. This leaves an incredibly thin cushion for error. Active deleveraging is visibly underway via the divestment of its gem office asset, alongside a fresh preferential offering, making this a developing restructuring story rather than a closed verdict. When an operator's interest coverage drops to 1.8 times, you are no longer investing in real estate. You are underwriting a bank workout. Lendlease Global Commercial REITs asset sales are a mandatory triage, not a strategic choice. While the macro SORA drop provides breathing room, a retail portfolio at 58 cannot afford to ride out a balance sheet repair cycle when the regulatory floor is that close. You do not buy an asset for steady retirement drawdown while the manager is performing emergency open heart surgery on the capital structure. Wait for the repair work to clear the gates. Looking across the full survey, the zone REITs tell the complete story. Fraser's Logistics and Commercial Trust sits at Zone 3 conditional, the cleanest balance sheet in the group. Keppel DC REIT, Capital and Integrated Commercial Trust, Capital and Ascendas REIT, Fraser Centrepoint Trust, Suntec REIT, and Lendlease Global Commercial REIT all sit at Zone 4 caution, each for different reasons. The gearing numbers alone do not separate them. The interest coverage ratio and the debt maturity profile are what determine whether Zone 4 here is a timing story or a structural warning. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. By the time this analysis reaches you as a free subscriber, the entry window has already opened and often closed. Iggy's elite investors get zero-day access on Substack and YouTube, the full Red Zone watchlist, and institutional-grade cheat sheets at the moment the setup is live, not after the market has already priced it in. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Ruffles Place, you stop being the exit liquidity and start being the analyst. When we align these yields against my structural benchmarks, the analytical picture solidifies. The 6-month T-bill cutoff yield sits at 1.48%, the latest closed auction as of mid-June 2026. The Singapore Savings Bonds 10-year average return rests at 2.11%. Both instruments sit completely below my personal 3.2% forensic floor. The CPF special account pays a guaranteed 4.0%, serving as our absolute risk-free sanctuary benchmark. My framework requires a 150 basis point premium above that rate for any equity position to justify open market risk. That sets the minimum yield hurdle at 4.7%. Looking across the scorecard, the majority of surveyed names carry yields that clear or sit close to the 4.7% hurdle at current market pricing. This proves the sector is still generating real, mathematically defensible yield premiums above risk-free options. The prerequisite is absolute. You must avoid the specific capital structures with broken coverage ratios. The macro tailwind lifts distributions for operators who deserve it. It does not rescue operators whose balance sheets were already compromised before the rate cycle turned. This structural shift requires a complete reframe of how you manage your wealth pipeline. Many retail investors think about retirement yield purely through the lens of monthly cash payouts. The higher fidelity approach runs through the SRS, Supplemental Retirement Scheme, to retirement account pipeline. If you accumulate reliable, high-yield distributions inside an SRS account during your pre-retirement years, those funds can be transferred directly into your CPF retirement account, allowing you to top up to the full retirement sum or enhanced retirement sum before formal retirement enrollment. The quality of your equity yields directly dictates your ability to max out those guaranteed national tiers. The macroeconomic debt wall that was supposed to break the backs of Singapore retail portfolios has been thoroughly dismantled by the collapse of short-end borrowing costs. The sector did its homework. Most major retail managers successfully defended their credit profiles, and the genuine outliers are clearly flagged and visible on the horizon. The macro tailwind is real, but your execution must remain absolute. If you are managing your own portfolio for long-term dividend survival, you cannot afford to wait for macro data to filter down to the public weeks after the market moves. Join Iggy's elite investors to secure zero-day access on Substack and YouTube, full red zone watchlist, and institutional-grade cheat sheets for $9 a month. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MIAS licensed financial advisor before committing funds.